As usual, it is helpful to immediately mark the open, high, low, and close prices from the first day of trading after a stock has begun trading on the stock market. The 37 and 38 levels can also be of importance since they were the site of upswings shortly after the IPO. The relatively horizontal range turns out to be part of a flatter head and shoulders variation that has additional validity with price action neatly contained within its outline. The IPO price ranges can conveniently be reused to mark the approximate neckline and shoulder level. As well, there is a normal downtrend line to reference from the head and right shoulder downswings. A sharper downtrend line can also be derived from familiar bullish retracements after the neckline break in early August. After crossing the steeper downtrend line, there was normal neutral to bullish price action that even included a strict double bottom in October. However, the broader context was overwhelmingly bearish, and the larger downtrend can likely continue. The chart now returns to the recent wider gap fill that reuses the 30-50 level, which had also been the first double bottom's upper boundary. In this case, the gap down fill did provide firm resistance, but the early uptrend was eventually able to move past it. Selling pressure continued to remain at mostly normal levels after the early November double bottom was followed by periodic bullish volume spikes and a series of upswings on a stable incline. This was summarized by the new uptrend line. The uptrend was in full force after crossing the upper downtrend line from the head and shoulders, which is why it is less of a surprise Uber has now returned into the heavy resistance area marked by the earlier ranges near the IPO price. The 37 to 38 levels conveniently mark the lower boundary of the declined double top in the IPO range due to the gaps before and after the pattern forms. The volume is also distinct here as the double top outline itself has below normal volume contrasted with the bullish acceleration before and the bearish acceleration after the new downtrend begins. When recovering from new record lows, there is slightly stronger resistance due to the last major lower range in the mid to upper 20s, along with the intersection of the old downtrend line and a newer one from the last downtrend. Similar to the recovery from the head and shoulders, the upper descending trend line from the double top is crossed, but there is strong resistance shortly after. This time it is mainly due to the wider lower boundary of the double top. This time, firm support has established around the 30 boundary. Selling pressure remains moderate to even high at times. However, there is a noticeable increase in bullish strength, as evidenced by the simple observation of more green on the chart after August 19th, when strong selling pressure failed to breach the firm support range. Given these conditions, the chart is more neutral than bearish in the short to medium term. After crossing over the double top's upper descending trend line, there was a potential bearish continuation as there was a horizontal resting phase from June to late July. However, this needed to have an extended lower boundary due to the low in the old 3050 to 2860 range in late June. Since this area was not broken, there was no classic bearish continuation or descending triangle despite favorable conditions up until mid-August. A potential bearish reversal range also failed near the last moment as another sharp bullish spike emerged in early September. In fact, it could be said there was a large-scale reverse head and shoulders outline starting just after the break of resistance from the head and shoulders in the IPO range and the bearish to neutral price action from September to November was a horizontal resting phase range in a bullish continuation. The IPO range and previous record highs in the mid-40s would certainly present heavy resistance, but there was enough bullish volume to eventually surpass it. Note the major decrease in volume in late November is due to the Thanksgiving holiday period and a natural period of deliberation in the market after such a major bullish surge. Nonetheless, volume still remains constantly bullish for most of late November. This is an important detail as to why the mid to upper 40s offer strong support despite a drastic shift to bearish volume towards 2021.